Today, we will talk about equity derivatives. An equity derivative is a financial instrument whose value is based on the equity movements of the underlying asset. For example, a stock option is an equity derivative, because its value is based on the price movements of the underlying stock. Investors can use equity derivatives to hedge the risk associated with taking long or short positions in stocks, or they can use them to speculate on the price movements of the underlying asset. Equity derivatives can act like an insurance policy. The investor receives a potential payout by paying the cost of the derivative contract, which is referred to as a premium in the options market. An investor that purchases a stock can protect against a loss in share value by purchasing a put option. On the other hand, an investor that has shorted shares can hedge against an upward move in the share price by purchasing a call option. Equity derivatives can also be used for speculation purposes. For example, a trader can buy equity options, instead of actual stock, to generate profits from the underlying asset's price movements. Equity options are derived from a single equity security. Investors and traders can use equity options to take a long or short position in a stock without actually buying or shorting the stock. This is advantageous because taking a position with options allows the investor/trader more leverage in that the amount of capital needed is much less than a similar outright long or short position on margin. A futures contract is similar to an option in that its value is derived from an underlying security, or in the case of an index futures contract, a group of securities that make up an index. For example, the S&P 500, the Dow Index, and the Nasdaq Index all have futures contracts available that are priced based on the value of the indexes. However, the values of the indexes are derived from the aggregate values of all the underlying stocks in the index. Therefore, index futures ultimately derive their value from equities, hence their name, equity index futures. Here are 3 key takeaways. 1. Equity derivatives are financial instruments whose value is derived from price movements of the underlying asset, where that asset is a stock or stock index. 2. Traders use equity derivatives to speculate and manage risk for their stock portfolios. 3. Equity derivatives can take on 2 major forms, equity options and equity index futures. Equity swaps, warrants, and single stock futures are also equity derivatives. Hope this would help. Thanks for watching.